This week, the VIX crossed 65, which is the fourth largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's fourth after 08-09, the tech and telecom bubble in 2000, and 1987. Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment, or is in a cathartic moment. And it usually means something is changing.
If something is legal tender, I'm much more likely to want to vibrate it or transact at high frequency. And if it's going to be taxed heavily, short-term capital gains tax, right, is like 35-40%.
I do believe that the Fed now is on high alert because the stock market seemed to be encouraging the Fed to hold tight, higher for longer, make sure that inflation was out of the system. And as you know, we've been saying for quite some time that inflation is unwinding much faster than we're seeing in the traditional indexes. Right now, the CPI is at 3.1, but by other metrics, we're seeing prices fall.
Cathie Wood begins by addressing the recent spike in the VIX, a measure of market volatility, which crossed 65, making it the fourth largest spike in the last 40-50 years. She compares this event to other significant market disruptions, such as the 2008 to 2009 financial crisis, the dot-com bubble, and the 1987 market crash. This heightened volatility, she explains, often signals a cathartic moment in the markets, where significant changes are taking place. Wood posits that this volatility could be an indicator that the U.S. economy, and possibly the global economy, is undergoing a rolling recession. This term suggests that different sectors of the economy are experiencing downturns at different times, rather than all at once, creating a more prolonged and uneven economic contraction. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
This week, the VIX crossed 65, which is the fourth largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's fourth after 08-09, the tech and telecom bubble in 2000, and 1987. Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment, or is in a cathartic moment. And it usually means something is changing. And as you know, we have believed for quite some time that the U.S. economy, and maybe the global economy, has been going through a rolling recession ever since the Fed started raising interest rates. Well, the other thing that was happening during that time, apparently, was an increase in the carry trade involving borrowing yen, so really shorting yen, and buying dollars and investing them into higher yielding assets than in Japan, so playing the spread. The other reason this became a very widespread trade is the yen has been depreciating. So shorting yen meant that the investor or the speculator was benefiting from the yen going down. Well, that changed abruptly this week as the Bank of Japan increased rates more than expected and seemed more determined to continue increasing rates than many people expected. So apparently, lots of margin calls and a sell-off in a lot of assets. And now the VIX has calmed down. Now, we're not sure if the carry trade has unwound completely. JP Morgan is saying we're halfway there. So perhaps we'll see some more volatility, but I do believe that the Fed now is on high alert because the stock market seemed to be encouraging the Fed to hold tight, higher for longer, make sure that inflation was out of the system. And as you know, we've been saying for quite some time that inflation is unwinding much faster than we're seeing in the traditional indexes. Right now, the CPI is at 3.1, but by other metrics, we're seeing prices fall. And we would not be surprised to see prices fall a little more broadly as the consumer weakens. Now, why is the consumer going to weaken or continue weakening? We believe it's because corporations are losing pricing power. And in order to salvage margins, they're going to be doing two things. They will be laying people off, and they will be accelerating moves to increase productivity. So the unemployment rate will go up. That certainly is getting the Fed to change its spots, as we're listening to Chairman Powell. And I think now that household net worth being hurt by the stock market going down is another reason that the Fed is going to relent. Now, one last thought here. Interest rates coming down should be very positive for the equity markets, but they will not arrest a recession very quickly. In fact, if consumers and businesses know that interest rates and maybe prices are coming down, what will they do? They will wait. Now, the market in its wisdom, we believe, is already understands much of what I have told you. And so we do think that lower interest rates, when this carry trade is completely unwound, that lower interest rates are going to be the defining factor in terms of a rotation in the market away from a very concentrated group of stocks to a much broader based group of stocks. And as I just mentioned, innovation solves problems. So productivity gains are certainly what we believe is going to happen as AI proliferates throughout the global economy. So we just wanted to give you some insights based on lots of years of experience, having experienced these volatility, cathartic moments. It usually means there is a rotation into a new kind of thinking underway. And we do believe that will play out during the rest of this year.
Michael Saylor remains optimistic about the potential for innovation to drive productivity gains and economic resilience. He highlights artificial intelligence AI as a key area where technological advancements are likely to have a profound impact on global economic dynamics. Saylor believes that as AI continues to proliferate, it will help companies enhance productivity, offsetting some of the negative effects of economic downturns. He suggests that investors should focus on innovative companies that are well positioned to benefit from these technological trends, as they are likely to outperform in the long run.
When you're doing a transaction, what is the impedance? And there's a source of physical impedance. Like, for example, what do I think of gold as a transactional currency? Well, I don't think it's good because it's hard to subdivide it and it's hard to send it over the mail. And so you can see how there's a high energy cost to trade gold high frequency. That's why it died. On the other hand, what do I think of Apple stock as a transactional currency? And here you just get into politics. In a country where Apple stock was legal tender if it's legal tender and I can send it to you and you can send it back to me and I can do it in 1 second with no tax, then, wow, Apple stock is better than gold. Now, what do I think of the dollar as legal, as a transactional currency? Well, what I think is I can send it back and forth 1 million times a day and I don't have 1 million taxable events, and so I don't have to account for it. If I send a capital asset, whether it's a corporate bond, an equity, Bitcoin in the US, if you're in the US now, if I move it, I'm moving it at high frequency and I'm incurring an accounting event and a taxable event. And if you do the calculation, it just turns out that everything just costs 10 or 20% more. And so if we were talking about a country, El Salvador, where it's legal tender, and I can move it back and forth 100 times a month, and there is no accounting event, and there's no taxable event, then my opinion is, if it's Satoshis on Lightning, I kind of like it. If it's Satoshis over the base layer, I think at some point the friction is, when it's $3 a transaction, there's too much friction. So I don't like it on the base layer. I do like it on the second layer. But I would counsel anybody that if you had a certain amount of money, 95% of it should be held in the capital account as Bitcoin. 5% should be in the local checking account. And as a practical matter, you've got two things. In Argentina, if everything's priced in the peso, and then you have to have pesos, I would probably buy them the hour before I had to spend them, but I would buy them. And on the other hand, if something is legal tender, I'm much more likely to want to vibrate it or transact at high frequency. And if it's going to be taxed heavily, short-term capital gains tax, right, is like 35-40%, right? So if I gave you a Bitcoin and it was up, a bit, and here's the thing I think we both agree on, Matt, which is neither one of us think we should send all our money to the government. Right?
Very true.
And I think that's why, for example, Tether has been so successful. In theory, a digital currency that's a dollar, that's pegged to the dollar for high frequency checking, and a digital property, Bitcoin, which you can hold for the rest of your life as the property or the capital asset. Those two paired would allow you to go anywhere in the world and stay rich or stay wealthy and stay compliant and minimize, what do you want? You want to hold the Bitcoin forever and never pay capital gains. You don't want to and you never, you just want to hold it forever. And then you want everything else to be quick and easy. So that's what I think on that subject.
Saylor reflects on how these periods of heightened volatility often signal a shift in market dynamics and investor sentiment. He believes that the current environment is no different, with significant changes underway that will reshape the market landscape in the coming months. Saylor encourages investors to stay informed and be prepared for potential shifts in market leadership, as the conditions that have favored certain sectors may not persist. He emphasizes the importance of remaining flexible and open to new opportunities, particularly in the areas of innovation and technology, where he sees the greatest potential for growth. Please like and subscribe my channel.